Hello everyone, my name is Kelly Olivo and I'm here today to present to you a PowerPoint on qualitative and quantitative conducting sensitivity analysis. Sensitivity analysis. Using sensitivity analysis, a firm can estimate what will occur if the project's assumptions and estimates prove to be inaccurate. Sensitivity analysis aims to determine the effect of varying calculations, assumptions, or projections on the project's finances. Thus, it prepares the business's managers for the possibility that the project may not produce the anticipated returns, allowing them to assess the project more thoroughly before investing. Researchers must also determine the maximum, more or minimum input and uncertainty values are associated with the primary cost drivers for sensitivity analysis. When attempting to find out the most influential elements on prices, a cost estimator must evaluate each cost component's relative relevance. A budget sensitivity analysis enables you to understand your cash position, exposure to risk comprehensively. Understand how seemingly tiny adjustments can have far-reaching effects on your business and finances. Qualitative and quantitative steps necessary in conducting a sensitivity analysis. So this is very important. Recalculate the total cost by permitting one of the expenses to fluctuate between two preset ranges. So you're going to have your maximum and minimum or manufacturing tolerances. For example, you're going to calculate the output variable for a new input variable while maintaining the other assumptions. Maintain a record of your results, and you're going to repeat 2 and 3 steps until all indicated factors in step 1 have been independently tested. You're going to evaluate the results to identify which factors impact cost estimate the most. Project risk incorporated into capital budgeting analysis. Capital budgeting is a business planning technique to evaluate which investments are worthwhile. Consequently, in capital budgeting, project risk is considered uncertainty over a project's profitability. There is the prospect of danger if the potential of selected activity has undetermined effects on the anticipated cash flow profitability. The risk-adjusted discount rate and the certainty equivalent methods are the principal strategies for incorporating project risk into capital planning. Project risk incorporated into capital budgeting analysis. Similar to other investments, hazards primarily affect project needed rate of return, discount rate. To determine the likelihood of a risk, businesses may utilize past data to estimate the riskiness of the proposed venture. However, there are cases in which it is difficult to gather historical data. Hence, managers must rely on a subjective assessment, as is frequently the case in capital budgeting. When undertaking financial planning, numerous forms hazards they evaluated. Consequently, they vary based on the circumstances. The more classified as a standalone corporate and market or beta risk. Methods for including risk in capital budgeting analysis. An additional discount rate is added to the risk-free interest rate. It is calculated by looking at the returns of investments with little risk, such as government-backed securities. Investments like startups and venture capitals are selected with higher returns. Payback period. The investor is concerned with the time it takes for a project to recoup the initial investment. Investors choose a time frame during which they anticipate receiving returns. The cash flow of each project is determined. A risky project is one of whose returns falls beyond the specified time frame. Certainty equivalent and sensitivity analysis. The certainty equivalent coefficient determines future cash flow risk. Investments with a low certainty equivalent rating are avoided. This is due to the low likelihood of netting the expected cash flows. Certain cash flows are derived by multiplying uncertain cash flows by a specified basis versus sensitivity analysis, that is variables including sales, investment, tax rate, and cost of sales influence return on investment. The sensitivity analysis analyzes the degree to which the cash flow of a project vary in response to one of these elements if the project cash flows are susceptible to changes in any of the elements mentioned above. The project is deemed hazardous and hence avoided. If you would like more information, here I have put some references. We have the Irons R 2019, The Fundamental Principles of Finance by Taylor and Francis Group. This is a very good book and literature to look into. And below you'll see further references that you can look into if you would like more information. Once again, signing off, my name is Kelly Olivo.